Thank you for watching this preview video at xm.com. We'll be discussing upcoming U.S. inflation data and the Fed meeting on Wednesday. I'm Maria Pachordes, and joining me is Senior Investment Analyst Marios Hadjikyriacos. So Marios, inflation has been falling steadily in the U.S. What are we expecting from the inflation data coming out on Tuesday?
Hello, Maria. We are expecting a continuation of that, essentially. So the inflation has been falling steadily in the US this year, and the markets expect to see this trend continuing in November, mostly because of the declines that we've seen in energy prices during the month. Now, specifically, the forecasts, Maria, are for the annual inflation rate to have declined a little bit, but for the core rate to have remained steady. So some more progress, let's say, on the inflation front, but nothing too dramatic. Now, you have to also put this in the greater context of inflation has been falling in the US, but the economy is actually doing pretty well. So real economic growth is on track to hit 30% this year. The US consumer is still spending. The government, of course, is running an enormous budget deficit, and that is also helping to support growth. So the sense in the markets lately is that the US economy can achieve the elusive soft landing that the Fed has been hoping for. And of course, by soft landing, we mean inflation coming back down to target without the US economy going into a recession.
Now, on Wednesday, the Fed will announce its latest decision. Do you think there will be any changes this time? What should traders watch out for?
Almost certainly, the Fed is going to keep interest rates unchanged. So the markets are basically pricing in a 0% chance for any rate adjustments. So the market action, Maria, is going to come from the updated economic forecasts, the updated interest rate projections, and of course what Chairman Powell says during his press conference. Now, specifically, I think that the markets are going to focus the most on where the Fed sees interest rates ending next year. And the reason for that is what we've seen lately, Maria, is a lot of speculation in the markets that the Fed, with inflation coming down, that the Fed is going to start cutting interest rates next year, perhaps as early as in the spring. And that in turn has created a gap between what the Fed expected last time when they issued interest rate projections back in September and what the markets currently think is going to happen next year. And to talk some numbers, the last time the Fed issued its interest rate projections, the FOMC expected interest rates to end next year at 5.1%. But as we speak, the markets expect interest rates to end next year at 4.2%. So that's a huge, almost a 1% gap between what the Fed thought and what the markets currently think. So the question this time is the Fed going to lower its projections? Are they going to signal more rate cuts? And if they do, are they going to come to hug market pricing and signal the markets are right? Or are they going to signal fewer rate cuts than the markets are expecting and therefore push back a little bit against speculation in the markets for heavy rate cuts next year? Personally, I think they're going to push back. I think they're going to signal something that interest rates closing next year at something closer to 4.5, 4.6%. So yes, they will be cutting interest rates, but perhaps not as heavily as the markets currently think. And if that is the case, Maria, I think that would be a beneficial scenario for the US dollar, because it would be the Fed essentially pushing back against, essentially saying that the markets have gone a little bit overboard with pricing in so many rate cuts next year.
Marios, thanks so much. This was a preview video here at xm.com.